Welcome to Northwest Arkansas Investing Podcast, your go-to source for real estate investing in Northwest Arkansas.
Whether you're a seasoned investor just starting out, we bring you expert insights, market trends, and practical strategies to help you build wealth through real estate.
From buying and selling to property management and long-term investment planning, we cover it all so you can make smart, informed decisions in this fast-growing market. Let's dive in. All right, welcome back to Northwest Arkansas Investing Podcast. I'm here with Brian Wagers, and him and I are getting to talk through. We just finished up in our episode on the Northwest Arkansas market update. Now that we're at the midway point here at the end of July, and now we wanted to dive into episode 2 and kind of just talk through some investing strategies that we still see that are working in a high rate market that's continued to stall out as far as rates go, and what kind of continue to work. And I think, when you look at real estate business overall and the real estate as an investment overall, those that are the most successful, I think this is a very general thing to say, but it's a long-term game. It's years and years of waiting and working and optimizing and adding value. And I think that's what, at the end of the day, if you're going to be successful in the real estate business, whether it's brokering, whether it's investing, you're going to need to be doing deals when rates are high, and you're going to be needing to do deals when rates are low, and kind of understanding what works in both. And this is our first time, obviously. Brian, you're a little bit older than me, but we've almost only known the market to go up and rates to be pretty low, and now we've kind of had a few years here of higher rates, and what that looks like in the market and how it affects the market, and how sellers will stall out and how expectations need to change. And so I know we've got a few ideas here on kind of trends and investing strategies that we've seen work, but talk me through a couple of ideas or thoughts that you have on that you've seen work in kind of a high rate environment.
Yeah, I like how you approach that, and there's money to be made in any market. And we saw, like you said, we may not have been investing in real estate at the 2008 or anything like that, but saw what happened. And right now, I think strategies that will work. Right before this episode, we talked about days on market. So what I've seen, on the commercial real estate side, someone may have went out with a deal expecting to get X amount of $10 million, and they hit the market. Someone, brokers told them, we can try and see what we get. It stalled, nothing really happened, and they didn't sell, and maybe that deal was worth $7 million or maybe $8 million, and seeing it not trade, fizzle out for a couple months, and circling back with them and seeing where they're at and if they're more realistic. And a lot of times I like to be pretty quick about where it makes sense for me. But I think there's opportunity in these these sellers that, maybe they're getting more antsy to sell. Maybe they need to move their capital somewhere else. The best seller is a motivated seller. That motivation can be huge range of motivation, and huge, how urgent it is can range. But I think there's good opportunity in there. And then on the more residential side, putting an offer that makes sense on these aged listings. I know you hear it all the time, like listings on there, just submit an offer. Maybe they're more motivated. Maybe look at the older listings. I know there's strategy in going to expired listings. So same thing in commercial real estate. Maybe it's not even listed anymore. So checking to see if they sold.
Absolutely. No, I agree. I think the biggest thing is in any market is making money on the buy, right? And that's really kind of the main thing as an investor that I think is one of the more important things getting into a deal, more than optimizing and more than being a great operator is making money on the buy and buying it right. Because you can't, you've seen too many time and time again here in the last few years of guys that just didn't buy it right and prayed for crazy rent appreciations or hoped for something to happen that it was historically kind of something different that, rents went up 20%. And obviously historically that's not typical, and they continue, projected for rents to continue at that rate or something along those lines, and now found themselves in situations where they had to give up the property, and stuff like that, or sell at a loss. And so I think just something to continue to keep in mind. But a few strategies I think that we've seen. Number one, we've talked about it time and time again. This is easy for those investors that are smaller and maybe don't have a portfolio, any size portfolio, or maybe they have 1 or 2 units and are willing to kind of move around and sacrifice a bit, but house hacking. And so, buying a multi-unit building, or even buying a single family home and living in one of the units or living in one of the rooms and renting out the other rooms. You and I both experienced this at some point in our life. You with a single family home, me as well. And so I think, as we look at, for instance, I've got some duplexes for sale in Bentonville, and, most folks can't really make those numbers work because prices have exceeded where rents haven't caught up to where the prices are, I guess. And so from an investor standpoint, unless you're putting more than 25% down, it's going to be tough to make the numbers make a lot of sense over time. And so a lot of the buyers that we've had in this neighborhood with rates where they are able to kind of take advantage of seller credits and are able to take advantage of lender credits, get into a property like this at, quite a bit less out of their pocket, and kind of be able to work and optimize the property, maybe add some value with new countertops or whatever, and then continue to push rents over time to eventually be able to move out and cash flow or sell it in a few years and roll that into the next property. I know you have experience with that as well. Was that something that you were thinking about when you were first getting started, and was that something that you were able to sell and then roll into a better opportunity that helped you continue to?
I did do a little bit of a house hacking when I first got started with, I rented out a room to my girlfriend and now wife and baby mama, and to one of her friends too. Mm-hmm. So she was paying rent and her friend was paying. It was just a house. So I think there is opportunity there, like on those times where you're okay with the equity and you're placing your money, as long as it's, for me, it was still a utility of I'm living in it and getting in it. So I think for the duplexes, it depends if it's as an investment or someone who's buying it for a first-time home and they're okay. I think it just depends on the investor's situation too, like what they're, like you kind of mentioned,
totally,
on their strategy. Is it most times first-time home buyers that are going in there, or more investor types, or a mix of both?
It is first-time home buyers for the most part, but it's been interesting. I mean, we've sold 12 to 13 of those duplexes in the past few months, past 3 or 4 months, and 60% of the buyers have been, living on one side and renting out the other. So it's not, an insignificant amount of people that are doing this and looking to do this. And for most people, that takes a payment, that can easily be over $2,000 a month in buying their first home, to, when you can supplement that with rental income from the other side of the duplex or whatever it may be, to something that, you basically would be getting if you were to be renting somewhere, which is, $1,200, $1,500 a month, somewhere in there.
How much are they rented out, one of those sides?
And in that neighborhood specifically, it'd be anywhere between $1,200, $1,500, depending on the size of it per side. So it's, something that somebody could get in, and as they live in it, they can be supplementing at least half of their mortgage. And then, as rents continue to rise, as they continue to add value over time, then eventually they can move out and be making some cash flow. And so I think it's a strategy that can be used in any market, and any rate market especially, and one that's just kind of an easy, low barrier to entry opportunity, especially in today where there's, we're up 20 to 30% in inventory year over year, and sellers are getting a little bit antsy, like we've talked about, and are willing to offer more credits. There's more of an opportunity to get in for little to no money outside of your down payment. So I think it's a strategy to kind of keep in mind.
Yeah, in commercial real estate, it's called owner occupied. Where the owner or one of the business owners owns the building and one runs their business out of all of it or part of it.
Yeah.
So I think there's opportunity. A lot of commercial real estate investors do that here, where they have a business out of part of it.
I love it.
So yeah,
I love it. So and then kind of talking through other strategies. Something else that I thought about as far as an investing strategy that works and that continues to work in a high rate market for me, and I've seen this personally recently, would be seller financing. I don't know, Brian, you have experience with that when you were first starting to buy apartment complexes. But to me, working on a deal right now, hopefully we'll get to talk more about in the coming months, that owner is willing to do seller financing, and historically, he wants that around a 6 to 7% rate. I think we're going to end up somewhere in the low sixes on the rate, but that's a pretty historically good return for somebody that it'll be completely passive for this owner. He doesn't want to take a big tax hit right now, and he wants to continue to make income but not have to manage the tenants and stuff like that. And so I know you have done this as well, seller financing. In a high rate market, does it feel like there's a better opportunity for seller financing than if rates were low?
Yeah, I think so. Yeah, because of the stalemate in the market. They're not getting as much as what they thought they were going to get for the price, and because the next person is going to have to borrow at now 8%, 7, 6, 8%. So if they can finance it, it makes more sense for the investor, and they can get closer to their purchase price. And seller financing has a ton of other benefits outside of that, depending on how you're structuring that, where your leverage point. But I think it's a great strategy in a higher rate market, especially when they can't go out and borrow, for their next deal either. So they are okay being the bank in those scenarios. So yeah, I think that's a great point. And I think in a high rate, and for seller finance specifically, I think it does make more sense in a high rate market. But just like any market, you still want to have the same strategies. You want to buy right. You want to make sure you're buying at what makes sense today. You're not speculating too much, but you also have to have certain assumptions on rent growth, expense growth, total income growth. So I think
absolutely
trying to be disciplined there. And right now, it can be frustrating for some, because it feels like we are working a lot harder right now, and maybe not moving the needle as much. But I think the market will reward those who are continuing to push when the needle isn't moving as much. So I can be harder to make deals work, harder to transact, but it also weeds out higher. A strategy is keep going, because in a high rate market, it weeds out people too, people that wanted to come in and finding out how hard it is, or how to navigate it too. So that's another benefit.
Yeah, agreed. Curious too on seller financing. I think it's a great point to continue to expand on, because although it seems like something a little bit harder to do nowadays, it's not impossible, and there's still, I think, a lot of opportunity out there for sellers that just simply want to try to move the tax liability out a little bit, and maybe it's taking less of a hit now and spreading it out years to come. I've seen guys out there that'll seller finance something with no balloon and pay a ridiculous price, but at a low rate that they're able to still make work with the numbers. I've seen guys only be willing to do like a 2-year seller finance note or 2-year balloon on their seller finance note. How did you structure those deals for you back in the day?
Yeah, and there's a bunch of different ways to do it. If they're wanting to be if they're going to replace the bank, if they're going to supplement the bank, it all depends there. I did a 5-year balloon. Mm-hmm. That's great if you can have them not do a balloon. You might want someone they might say, oh, I'll give you a temporary seller credit for 2 years, 18 months, 3 years. But I paid them all off in 18 months, all my seller financing deals.
Oh, yeah.
Didn't pay them off, but I refinanced out of them within 18 months.
Gotcha.
Or on my first several. I still have one seller finance that the seller is still in, actually. But yeah, that's how I structured it. I did 5-year balloon. They actually came up with a down payment. They were okay sitting in second position. So some of them will not want to be okay sitting behind the bank, because then they're at fully leveraged. They're at like, what happens if it goes back to the bank? Then their equity is like their seller financing portion is. So they have more risk if they do that. Just depends on. Some might want you to put in your own equity too and pair that with their seller financing, which is pretty common. And some, like you say, are just hey, we're going to do just like a bank. I'll give you 6%, and those little interest, if they're doing the full loan, having, offering them 6% is pretty nice, because what they can see how much they're getting in just interest alone on those payments. If you're able to amortize that at a 30-year, 25-year. But for me, I didn't have it amortized. I just
interest only on yours.
Interest only, yep. And then you could pay them per, and that's also another part that you have to hash out if you're going to pay them a set a month amount. If it's a cash flowing deal, if it doesn't have cash flow, so you want to figure that out too, as far as what you're paying them. I don't know what your deal is. A cash flowing deal.
Yeah, should cash flow. It will cash flow from day one, but it'll be interest only, 24-month balloon.
Mm-hmm.
But yeah, it's kind of a set. It's not amortized over any particular amount of years. It's kind of a set percentage and amount that'll be paid every month.
Yeah.
And then, of course, just a down payment up front. So I think some of the downside of that is, like, this one in particular will require a pretty good amount of upfront cost, to renovate the units, and they're pretty tired. But I think there's opportunities out there.
So he's going to be the bank?
Yeah, he'll just be the bank for it.
Yeah. How much are you proposing to put down?
I mean, it'll be 200 to 250, somewhere in there. So for yours, though, curious on the refinancing in the first 18 months. Was that because you got the property, you operated it well enough to be able to get it to a point to refinance and kind of restructure, and it made more sense with the bank? Or were you able to use the bank's funds to do more renovations, or what did that?
Yeah, I would say that's a big part of it. I was able to force appreciation, but also market appreciated, also where interest rates went, it made sense. So it was a combination of being able, like, because I wasn't expecting to do it until 3 years. So, I knew I was expecting 3 years, I would force appreciation, get in there, do the CapEx work, and fix it up, and have enough equity to pull him out.
Yes.
I knew there was enough equity on the buy too. Like, I knew my LTV was so much higher than my, actual costs going in. So I knew there was a good buy. Obviously some of that had to come from renovations, and the seller financing deals do make, like, especially if there's a balloon on it, it makes a lot more sense on a big value add deal. If it's not a value add deal, then I'd be careful about having a balloon on there, because who knows how, like, if you're not doing any big lifts, how long, you're putting, like, a lot of that's on the market,
right?
So
yeah,
you have to account for that.
Absolutely. But yeah, I think all that to say, we wanted to talk through a couple investing strategies that we feel like will still continue to work in a high rate market like we are in right now. And we have no crystal ball on what's coming, but we know that our president is definitely pushing for lower rates. I think it makes a lot of sense with the inflation numbers that we're seeing. Not to get political or anything.
Hey, release the files.
But we I think at a minimum, with the new group that will come in after Powell and them, which I think they're out at the beginning of next year, is the end of their term, then I think we're certain to see some sort of change. So I think just something to keep an eye on for early next year. Other good things that we're seeing right now, 100% bonus depreciation is back. A lot of great things with the new tax bill for real estate investors that we are not CPAs, but we'd love to get into at some point as time goes on. But overall, I think the sentiment is just continue to make sure that you're making money on the buy, and there will always be ways to make money in a high rate market, low rate market, even in a slow market, and so continue to plug away. And Brian, any final thoughts there?
That's right. There's a lot you can speculate on, but there's also a lot in your control. So,
absolutely. Well, thanks for listening, and tune into our next podcast. We're going to be talking about where growth is going, infrastructure expansion, and that'll lead us right into our next podcast with Tyler Overstreet with City of Bentonville. So thanks again for your time, and appreciate you listening.
Awesome, guys. Talk to you soon.
Again, thank you guys for tuning in. I'm going to go ahead and list some sponsors off here. We're going to start with Whinstone Private Lending. This episode is brought to you by Whinstone Private Lending, one of the top private and hard money lenders now serving Northwest Arkansas. Whether you need short-term capital for a flip, a bridge loan, or creative financing, they've got you covered with very flexible products to fit nearly any deal, including 100% financing. What sets them apart is their deep expertise, fast response times, and ability to think outside of the box to help investors like us close quickly and efficiently. If you're looking for a real lending partner, check out Whinstone Private Lending. Link is in the show notes. Our next sponsor is Advantage Title and Escrow. They're a local company. They do great work. Specifically, Kayla Phillips. I can speak personally on this sponsor because I use Kayla for all of my transactions. It's been 2, 3, 4 years now, and Kayla and I have done a ton of deals. We probably do between 65 to 80 deals a year together. And they do a great job. The SOPs, so systems and processing that they have over Advantage Title is just incredible. Clients love it. They do a great job from start to end communicating. When I give a deal to Advantage Title and Escrow, I know that it's going to be taken care of. There's no second guessing. I almost am able to treat them like a second transaction coordinator to my transaction coordinator that I already have. I know that they're going to handle the systems and processes correctly. As an agent, as a homeowner, as a buyer or seller, they do an incredible job of handling a transaction and communicating throughout the process. They do a great job with communication, especially Kayla Phillips over there. I would highly encourage you, if you're looking to close on a home, buy a home, if you're an agent listening, to use Advantage Title and Escrow, specifically Kayla Phillips. So you're going to reach Kayla best at 501-358-1601, or you can email her, Kayla, Cayla, at goadvantagetitle.com. Advantage is ADVANTAGE title.com. If you enjoyed the show, make sure to give us a follow on your favorite podcast platform so you never miss an update.
Don't forget to connect with us on Instagram, Facebook, and LinkedIn for more real estate insights and behind-the-scenes content.
Have a question you want us to cover? Send it our way. And if you're interested in sponsoring the show, visit nwainvesting.com to get in touch. Thanks for listening, and we'll see you next time.